Oh, this is a good one. User asks, Danny, how do we balance the desire for high returns with the fear of making a mistake? Well, my friend, the first thing I would say is the only time that you are going to make a mistake is when you make fear-driven decisions. But the other time that you can make a mistake, and I think this is what you're insinuating, is when you make a decision based on or predicated upon greed, right? So there's a lot of deals out there that are too good to be true. And so I think the underlying question here is, hey, Danny, how can I discern when a deal is too good to be true and I'm actually going to get burned? And to be fair, there's not a one-size-fits-all answer or approach, but generally speaking, what I would say is an experienced operator, an experienced sponsor, someone who's done this type of deal before is not going to put in front of you some crazy number that is going to blow you out of the water and make you want to invest into the deal. Typically, the best groups are the ones that underpromise and they over-deliver. And the groups that need the capital, and because the deal really isn't that good, but it's the only deal that they have right now, and so they want to make their acquisition fee, they want to make their money. And so what they're going to do is they're going to inflate the numbers. And you see this time and time again where sponsorship groups basically have like a target return metric in their mind. They're like, hey, we want to offer like a 25% rate of return to our investors. Okay, great. Let's reverse engineer into a pro forma that's going to get us those desired returns. And it's basically fraud, but there's no way to really discern whether or not they're doing something like that unless you really know what you're doing, paying attention to the pro forma and really digging into the numbers and looking at, the CoStar reports and looking at the projections for the market and seeing, if they're in alignment with what the business plan is saying is going to happen. But that's really difficult for a limited partner, for an investor with not a lot of time and experience to vet. And so there's a couple of ways to kind of overcome this. The first one is only work with groups that you know, like, and trust and have a great track record, or partner with someone like myself, like a fund of funds manager. We specialize in grouping funds together and placing large checks into deals. And you have someone like myself as a second layer of vetting, right? So there's an added layer of protection there because I'm also going through the underwriting and I do have the time to vet the sponsorship group and everything and make sure that the business plan is not inflated and it's actually rooted in reality. But as long as you trust the sponsorship group or you've partnered with a fund manager like myself that can help you discern whether or not this is a good deal, as long as you've done one of those two things, don't fear making a mistake. At the end of the day, all investments carry risk. So you're going to have a loss here every once in a while. And that's just a part of the game, right? But don't allow that fear to keep you from making a decision, right? Because the worst thing that you could do, the worst in making a mistake is not even taking action, because through action, you learn. And the more experience you have, the more discerning you'll become and the better investor you'll be, right? So it's a perpetual cycle. The fear of making a mistake will keep you away from being a better investor because you just won't get those reps in.